if you think of it, Bill, from the perspective of the bucket theory, that if you're going to be spending money, you're going to spend the most liquid money, and then the buckets that are illiquid would be money you'd use many, many years later. So that makes sense, right? Then that money is, you can go for a little better return because you're not going to use that money in the near term, and you know that, right?
It certainly. So there are two thoughts. That number one is the bucket theory, Brian, which you just described very, very well. The other, I think, important consideration for alternative investments is the lack of correlation, or the very low correlation relative to the public markets. And when I say public markets, both the stock market and, for that matter, the bond market. What's great in terms of investment, such as MHP with its Regulation A, is the coupon is 7%. It stays stable over the course of the investment. And as we're all too familiar with, there is a lot of volatility in the marketplace right now. And volatility, by the way, can be negative, it can be positive. But at the end of the day, volatility from an investor perspective, it really begs the question, hey, am I going to reach my goals, whatever those goals may be, whether it's retirement, college funding, etc. So it's nice to have a portfolio that is diversified, like you say, in terms of the bucket theory, but also diversified from the perspective that you have various assets that are not correlated to each other. That makes for a healthier, more risk-averse portfolio.